Good day. Welcome to another session of Folk Tutorials. Today we are going to look at depreciation of non-current assets. But before we proceed, remember to subscribe to the channel. It's very, very important. Subscribe to the channel, and you can even ring the notification bell as well, so that when I upload any new video, you get a notification right on your device. Thank you. Alright, so we proceed to depreciation of non-current assets. Now, I want you to understand that there is a difference between capital expenditure and revenue expenditure, which I've already explained in my previous videos. So capital expenditure is expenditure that is incurred in acquisition or improving upon the value of a non-current asset. And then revenue expenditure has to do with the expenditure incurred in the maintenance of the value of a non-current asset. Now, what is depreciation? Depreciation is the fall in value of a tangible non-current asset. Remember that with a non-current asset, we have tangible non-current assets, intangible. So we have the tangible non-current assets and the intangible non-current assets. Now, the tangible non-current assets, when they lose value, we call that depreciation. And when the intangible non-current assets are losing the same value, we call it amortization. So let us try and differentiate between depreciation and amortization. And so for non-current assets such as goodwill and patent and all that, those assets, they amortize, they don't depreciate. But when it is for property, plant and equipment, the tangible non-current assets, then they depreciate when they are losing value. We call it depreciation. And so depreciation has to do with the fall in value of a tangible non-current asset. Now, there are so many reasons why we have to make provisions for depreciation. The rationale behind depreciation is that as assets are being used for the business operations and for the generation of revenue, the portion of the assets that are being consumed should be reduced from the value of the asset. That is the rationale behind provision for depreciation. And so the accounting standards require that when we are doing accounting or we are preparing final accounts for the company or any other business that requires the preparation of a balance sheet, we should reduce the value of the asset by the portion that is consumed within the year. And so what we do is that we do provision for depreciation, and it is mandatory by the accounting standards. So depreciation is actually when the asset is losing value, the non-current asset, the tangible ones. Now, there are so many reasons that may cause the asset to lose value, not just the usage. Now, there are so many reasons, and so we are going to look at the causes, some causes of depreciation. As far as this topic is concerned, we are looking at causes of depreciation. Causes of depreciation. Now, one or the first common cause of depreciation that we can talk about is wear and tear. Wear and tear. Now, that is where the asset loses value through usage. So as you continue to use the asset, the value will not be the same. So whatever asset that you are using, as you use, it wears and it tears. And so this is when the asset loses value through usage. The second cause of depreciation is obsolescence. Obsolescence. Check the spelling of obsolescence very well. It's very important. And so what is obsolescence? Now, obsolescence is when the asset loses value through the introduction of a new technology. The introduction of a new technology causes the existing one to lose its value. For example, we all knew that previously typewriters were used widely in the world, but with the introduction of computer and this Microsoft Office suite, many of us switched from typewriters onto using a computer and the Office softwares, and so it made the typewriter outmoded, and so the values of typewriters in every organization drastically went down. And so that is what we call obsolescence, when your existing asset loses its value through the introduction of a new technology, we say that it is obsolete or obsolescence has set in. All right. Now, another cause of depreciation is passage of time. Time. The passage of time is a key cause of depreciation. Most assets lose value through time. Okay, so as you continue to use the asset and time passes by, the asset will lose value. Definitely, the value for the asset in the previous year will not be the same as the value of the asset today, and that is what we mean by passage of time. And so, when time causes your asset to lose value, we say that it has lost value through the passage of time. And that one is when the asset is aging. Yes, let me say aging. When your asset is aging, then it's losing value through the passage of time. And then the next cause of depreciation that I can talk about is inadequacy. Inadequacy. Inadequacy is the situation when the assets that you are using cannot cope with the new demands or the existing demand of the organization. Maybe you are using the assets for production, and initially you had demand from customers of about 1,000 units of your product, and the asset could be able to produce that within the same period that they are demanding. But now your marketing department has improved, your demand is increasing, and so you need to maybe produce like 5,000 units within the same period. Meanwhile, the asset or the plant or the machine that you are using cannot cope, cannot produce that 1,000. And so what will happen is that you may bring in a new machine that will be able to produce that 5,000, and that will make the already or the previous machine that you were using lose value through its inadequacy. So another reason that may cause an asset to lose value is inadequacy. This is when your asset that you are using cannot cope with the existing demands of the firm, and then we say that it has been depreciated through inadequacy. And then the next cause of depreciation that I can talk about is superfluity. 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 Now, this is the opposite of inadequacy. Now, inadequacy is when your asset cannot cope with the demand of the firm, and so it loses value because you have brought in a new one that can cope. Superfluity means that the asset that you are using now has lost value because of the decreasing demands of the firm. Like looking at the first scenario of inadequacy, we said that the firm's demand has gone up. This time you are using an asset that maybe is producing 5,000 units a day, and now demand has gone down to maybe 1,000 units. If you continue to produce 1,000 units with that machine, you may incur extra cost of the machine. So you just need a smaller machine now that can produce the 1,000 units exactly, so that you not bear too much cost with a bigger machine. And so in that case, the bigger machine is suffering from superfluity, and it is causing the machine to now lose its value because there is a decrease in demand of the firm's products. All right. And then the next or the final thing I may talk about, even though you may see more in other textbooks, is physical factors. Physical factors can also cause an asset to lose its value. Physical factors like rains, floods, the weather, wind, and even fire. Okay, so when these factors hit the asset, definitely with time the asset will lose its value. So these are some of the causes of depreciation that we can talk about. Okay, so we can also look at the purpose of depreciation. Why do we need to provide for depreciation? Why do we need to provide for depreciation? And so I would say purpose of depreciation. So the purpose of depreciation. Now, the purpose is the first one that we can think of as the first purpose, or why we provide for depreciation, is to spread the depreciable amount over the useful life of the asset. Okay, so the first purpose of depreciation is to spread the depreciable value of the asset over the estimated useful life of the asset. So for example, if you have the cost of an asset to be like 10,000 and a useful life of 10 years, then it's obvious and likely that for each year 1,000 will be used off. And so what we do is that we spread the 1,000 over 10 years. That is what we mean by spreading the depreciable value over the useful life of the asset. Okay, so there are so many reasons for calculating depreciation. We can talk about the fact that it preserves the capital of the business, and then also because of the matching concept, we match the costs we match expenses against revenue in the income statement, and depreciation is an expense, and so we provide for depreciation so that we can match the expense against the revenue generated from using the asset. And then also another reason for that is that we will not overstate the profit of the business. If you don't provide for depreciation, you may end up overstating the profit of the business. And so finally, I also say that it helps us to show the carrying amount of the asset in the statement of financial position. That is the net book value. And so if you don't provide for depreciation, you will not be able to show. So all those ones are points that you can organize as purpose or reasons why we should provide for depreciation as accountants. Okay, so putting that aside, I want to go on straight away to a very important part of this topic, and that is the factors to consider when calculating depreciation. The factors to consider when calculating depreciation. Factors to consider. Now, the first factor that you must consider in the calculation of your depreciation is the cost of the asset. The cost of the asset. Of course, you cannot depreciate an asset if you don't know the cost that you incurred in acquiring the asset. And so the cost of the asset should be considered as the first factor when you want to calculate depreciation. And we should remember them because as we move forward, we are going to apply the practical ways of calculating for depreciation. So of course, we must consider the cost as the first factor that we need to provide for depreciation. And the next important factor is the estimated useful life of the asset. The estimated useful life. Now, take note of the word estimated. It means that the useful life of an asset that we always talk about is usually an estimate. We only assume and predict that the asset will last for this number of years. Of course, experts may come in to help us get a more accurate prediction. But then, once we are not so certain about the future, we call it an estimate. And so estimated useful life is the number of years that we expect the asset to last in the business to help us generate revenue. That is the estimated useful life. And of course, we need to factor that in the calculation of depreciation. And then we can also talk about the estimated scrap value of the assets, or what you may call residual value. The estimated scrap value or residual value is also the amount at which we expect to sell the asset at the end of its useful life. When we have finished using the asset and we believe that the value is gone, at least there should be a value at the end that we should estimate. Okay, that this is how much we are going to dispose it of at the end of its useful life. And that is also what we call the estimated scrap value or the residual value. And then finally, we should also consider the method of depreciation. The method of depreciation. We should consider the method of depreciation. And so there are so many methods of depreciation. The most important thing is that the organization should choose one that will best suit their operations and the nature of the asset. And then, as much as possible, should be consistent with the method that has been chosen for that particular class of assets. And so that is what we mean. And so we are going to look at the methods, the various methods of depreciation that we have, and then try and understand how to go by them before we even start looking at examples. Methods. So, methods of calculating depreciation. We are going to look at the methods of calculating depreciation. Now, there are so many methods of calculating depreciation, but then I would like to focus on 3 for now. So, the first that I want to talk about is the straight line method. The straight line method. Now, the straight line method of depreciation is when the depreciable value is the same throughout the useful life of the asset. And so, what we mean by the depreciable value being the same is that if year 1's depreciation is $1,000, year 2 should be $1,000, year 3 $1,000 till the end of the useful life. The assumption here is that the asset is used the same way throughout the useful life of the asset. And so, what we do is that we have the same value for depreciation in every year. Now, the formula for calculating depreciation, the annual depreciation charge, under this method is your cost minus your scrap value, estimated scrap value, all over the estimated useful life. Of the assets. And so what we do is that it is the cost minus your scrap value over the estimated useful life. This is the formula for calculating depreciation with the straight line method. Of course, you can get percentages as well. And so it's either you are getting to use this formula or you are going by percentages. Now, if you are going by percentages, then it means that if you are giving 10% as the depreciation rate under the straight line method, and the cost of the asset is, let's say, $10,000, then it means that for every year, in the first year, your depreciation charge will be your 10% multiplied by $10,000, which is going to give you $1,000. Okay, this is what you are going to get for year 1. Now, in the second year, it's going to be the same 10% multiplying by $10,000, which is also going to give me $1,000. And so in year 3 it will be the same, in year 4 the same. This is what we mean by straight line method. It means that for every year, the value that we are going to get for annual depreciation charge is going to be the same. That is what it means by the straight line method of depreciation. And so that is just a tip of an iceberg. Of course, we are going to zoom into these calculations by taking practical examples. But then I just want you to have an idea about how we are going by the straight line method of depreciation. Okay, so the next method that we are going to look at is the reducing balance method. So method 2, reducing balance method. Reducing balance method. Now, the reducing balance method of depreciation is when the depreciable rate reduces year after year. Unlike the straight line method where we are going to have the same amount of depreciation for each year. With the reducing balance method, the rate of depreciation is not applied on the cost as we saw in the case of the straight line method. But then the rate of depreciation will be applied on the net book value or the carrying amount. The net book value or the carrying amount of the asset is the cost of the asset minus any accumulated depreciation charges that we have over the years. And so what we do is that we are going to apply the rate on the net book value. And so using the same example, let's assume that the cost of the asset is 10,000 with the same depreciation rate of 10%. And then we are going by the reducing balance method, and our estimated useful life is 10 years, looking at the rate. Okay, so if you want to calculate depreciation for the first year, year one, we are going to apply the 10% on the $10,000, which is going to give us $1,000 as the depreciation charge for year one. Now in year two, we are going to apply the same 10%, but this time around, it's not going to be on the $10,000, which is the cost. We are going to subtract this 1,000 is the depreciation charge for last year. So it means that we have already used 1,000 out of this 10,000, and so we have a net book value of $9,000. And what we are going to do is that our depreciation charge is going to be 10% on 9,000, which is going to give us $900 instead of the $1,000 previously. And so that is the idea with the reducing balance method. Now let us try year 3. In year 3, the rate remains the same, but then we are going to apply this now, no more on the 10,000 or on the 9,000, but then we should see that there is an accumulated depreciation of 1,900, this which is the first 1,000 plus the 900, and so we have a total depreciation charge of 1,009 for the previous years, which should also be subtracted from the cost of 10,000, giving us a net book value or a carrying amount of 8,100. And so we apply 10% on 8,100, and the answer is $810 for the third year. So we can go on and on and on. And so in the next year, we have to add this up to the total depreciation and take it out, and that is going to give us a reduced net book value. And so with the idea with the reducing balance method is that the asset is used extensively in the early years and then minimal in the later years. And so the depreciation charge for each year reduces as we move on the timeline or the time scale of the estimated useful life. And this is what the reducing balance method is all about. Okay, so the next method that we are going to consider is the sum of the years digit method. Sum of the years digit method. This is a very interesting method. Now, with this method, what we do is that we represent each year by a digit, and usually it depends on the estimated useful life of the asset. And so if the asset has 5 years, for example, of useful life, then we have year 1, we are going to have year 1, year 2, year 3, year 4, and year 5. So these are the years of the asset, and then each of them will be used as a digit. And so what we do first of all is that we add up the digits of the years. And so when we add up 1, 2, 3, 4, and 5, we have 15. So it means that the total sum of the digits is 15. And so what we are going to do now is that we have year 1 to 5. So with the same information, let's assume that our cost is $10,000. And even if you are given a rate for depreciation and you are using this method, don't go by the rate. Just keep the rate and use the digits. So we have 5 years to go. So in year 1, we are going to represent year 1 by the digit 5. And year 5 rather by digit 1 in that order. So in year 1, it's going to be the digit of 5 over 15. The reason is that we are now starting. So we have 5 more years to use. And so we use digit 5 for the first year. And then in year 2, we are going to use digit 4 over 15. 15 is the total sum of the digits. And so year 3, we are going to use 3. Year 4 will be 2. And year 5 will be 1. And so in year 1, we are going to have 5 over 15 times the cost of the asset, which is 10,000. And that gives us a depreciation charge of, this is 1/3, so we have around $3,333, something like this. So this is year 1. And then in year 2 we have 4/15 times the same $10,000. And then in year 3 we have 3/15 times the same $10,000. And so, ladies and gentlemen, this is how the sum of the years digit method is also applied. We use a digit to represent each year, and usually the first years are represented by the larger digits, and it descends in that order. And then we multiply each fraction by the cost involved, and that gives us the annual depreciation charge. And so this is how we go by the sum of the years digit method. We have other 2 methods like the revaluation method and the production methods, which I'm not going to stress so much for the purposes of this lesson. But then with the revaluation method, what we do is that we just compare the values of the asset at the beginning and at the end using their fair values, and we assume that the difference is depreciation. So this brings us to the end of today's lesson. In fact, this is just the introduction for depreciation. In our next video, we are going to look at the double entry for depreciation, and then we'll try and solve practical examples and enhance our understanding. Once again, please remember to subscribe to the channel. It's very, very important. Watch the channel, subscribe, watch the video, share with other people, let them also subscribe, let the network become a bigger one, and I know that all of us will climb up together. Thank you so much. See you again next time. Bye-bye.